Afternoon, everybody. Welcome to our webinar, Bluechip Financial Consultants. And we have Ruth Higgins as well too, and we're going to be talking about estate planning. Very important for everybody. Just to let you know as well too, what we have is up on the top right-hand side of your screen. You should be able to maximize the screen to make it actually bigger for yourself, to be able to view the slides. Just to let you know that there is a lot of information. Ruth has done a lot of work and given us great, huge detail. So there is the slide deck available if you wanted that. And also we are recording the actual webinar as well too. So the recording will be available if you so wish. There is the ability, if you go down to the bottom of your screen, in around the middle of the screen, that you should be able to see a pop-up on the taskbar, which gives you the ability to ask questions, which we will address during the actual presentation. If we don't get to your questions during the presentation, we'll get to them at the end. And if we run out of time, we'll definitely come back to you later on in the day or at the end of the week, okay? Just a few other little bits and pieces. What we will be doing is we will be running a few polls, one or two now coming up, just before Ruth takes over. These just give us an idea of people's information about what they know and the information that they may need to have. It just gives us a quick indication of people's, I suppose, thought process and where they actually are. Obviously, estate planning is crucial. We as kind of financial consultants in Bluechip, we come across it a lot with our clients. There's a lot of requests, hence the actual webinar, for people to have more information. What can they do? Proper planning. Unfortunately, everybody needs to plan because it's the one thing that is guaranteed, or two things that are guaranteed, tax and death. So combining the two of these makes it a lot better for everybody else, especially those that are left behind. So look, what I would say to you is the information is there, utilize it. We're going to run a few polls, and the first poll that we actually have is, before I do that, let me introduce Ruth officially. So Ruth, you're very, very welcome.
Thank you.
Ruth is a partner with McGowan, Solicitors up in North Dublin there. She advises on capital tax, wills, probate, trusts and estate planning. And also as well too, she's very much involved on the tax side of things as well too. Chairperson of the Taxation Committee of the Law Society, Tax Administration and Liaison Collections Committee. So a very well-informed individual, Ruth. Thank you for coming. What we are going to do is we are going to go through enduring powers of attorney, wills, advanced healthcare directive, which is an interesting one as well, farm property, lifetime transfers and nursing homes as well. So a lot of information we're going to try and cover, okay? And for the first poll, right, this is something that I always find interesting, is that what percentage of Irish adults surveyed made wills? So this was a Red C poll done in May of 2020. And if you could start filling in your answers there, it'd be great. And the interesting thing about this poll is the results are quite startling. Okay, so good numbers coming in there. 50% to 30% seem to be the actual main numbers. And I'm just going to end it there as well too. So that's good. And the one thing I would look at as well too is what people may have heard of is an enduring power of attorney. Ruth will talk about that a little bit more in detail, but for those that have heard, okay, this is poll one. Let's go on to poll two. Let's launch that poll. So question is, what percentage of Irish adults surveyed have an enduring power of attorney in place? It's something that is becoming more and more relevant for people as well too. Obviously, if you, oh sorry, this is the wrong poll, isn't it? Yeah, sorry, that's the wrong poll, guys. Don't know where that is. Anyway, our polls must have mixed up. Yeah, okay. Enduring power of attorney. Apologies about that. Anyway, technical difficulties do happen. Anyway, look, what I would say is that kind of enduring powers of attorney are something very, very important. Apologies about that coming so late and getting the wrong poll involved. Yeah, just very, very quickly. Yeah, about 6%. I suppose it ended there. Okay, great. Listen, thanks very much for doing that. As I said, the two polls are about wills and empowering enduring power of attorney. So Ruth, over to you, and let's see how well people did in their actual answers.
Thanks, Ubi. Just speaking of technical difficulties, there's an echo on my line.
You're fine with us, Ruth. There's no
Okay,
echo for us.
Fine. So you'll see the results of the poll. 30% had made a will, but actually, in fact, in the 65 plus bracket, 71% had made a will, which was quite good. But what we saw with the pandemic was it really brought estate planning to the fore. So this firm was inundated with wills, and we saw a lot of younger people coming in to make their wills for the first time. Enduring powers of attorney, there was an increase in them as well. And you'll see that in the poll, 6% had made an enduring power of attorney. Advanced healthcare directive, so that's also known as a living will, and there was certainly an uptake in those as well. People really giving some thought to what they might want in terms of medical treatment. Of those polled, 28% of those decided that it was time to make a will. This was a poll that was carried out by a group called Safeguarding Ireland, and they wanted to get a better understanding of people's attitudes towards planning ahead, so that's why it was commissioned. Move on to the next slide then. So really, estate planning, what it needs to cover, those three questions there in the slide. So what would you like to put into your estate on death? You cover this through a will. Can you improve the tax position of your beneficiaries? Again, you cover this through a will, and you also consider whether a lifetime transfer might be possible and which would be preferable. And the other question you need to cover is, have you arrangements to cover sudden incapacity? So you need to think, do you have arrangements in place to cover financial decisions, personal decisions, and medical decisions? So if we can move through those three areas today, it'll give us a good so then, enduring powers of attorney. This is a document that I think there's general, there's good understanding about what it is. The Law Society, the recommendations is if a person is single, if a person's recently widowed, solicitors tend to bring it to people's attention when they're coming in to make a will. It's you basically have to decide if you if you reach a point where you're unable to make decisions for yourself. Is there a person that you trust to make those decisions for you? So you can have up to 3 attorneys, and you can even separate the attorney. You can pick one attorney for personal care decisions and one attorney for financial matters, and you may wish to choose your accountant for that. It's important that you make it when you have capacity. If you lose capacity, it's too late to make the document then. So generally, if a person attends with their doctor and receives a diagnosis of some type of cognitive impairment, it's brought to their attention, then the doctor will tell them to attend with their solicitor and will inform them about this document. But often it's not possible to do that if there was a sudden accident, or if somebody had a stroke or some type of sudden medical issue. So for that reason, we advise people to think about the document, especially if you are a business owner, and especially if you are a person who has assets in their sole name, and if you really, once you reach the later years of life, it's a good idea to make it then. To give just an idea of cost, because there can be a huge range in what solicitors charge for enduring powers of attorney, it can be off-putting. Generally, in this office, if we have a husband and wife making enduring powers of attorney, it's a cost of around €500 plus VAT, and $350 for one person making an enduring power of attorney. But I have heard it can range up to €1,500 to €2,000, which is unnecessary for the document involved. But really, we're just trying to increase use of the document, and I think it is the cost that's off-putting to people. Yeah. Advanced Healthcare Directive then is on our next slide, and that is a document which allows you to choose what healthcare treatments you might want if there reaches a time when you're unable to communicate those decisions for yourself. The document also allows you to pick a designated healthcare representative. So that's a person who will assist medical practitioners in ensuring that the terms of the directive that you put in place are complied with. So in solicitors' offices, we draft a document, what's called a living will, And the living will generally say things like, I wouldn't want ventilation, I wouldn't want dialysis, I wouldn't want mechanical feeding. But there isn't actually a need to go through a solicitor to do this. There's a really helpful document that has been prepared by the Irish Hospice Foundation, and it's called the Think Ahead form. It's available on their website, and it's quite a long form, and a lot of pages in the form aren't relevant really from a legal point of view. It's just looking for details of bank accounts, that type of thing. But pages 11 to 14 are the relevant pages where it has helpful box ticking exercise where you can set out what you may or may not want in terms of medical treatment. So if there's one thing to take away from today, it's maybe to have a look at that form and think, is it something that you're interested in filling out? And you can even include the designated healthcare representative on that form. Next slide then, please. So will, you'll all be familiar with, and one of the questions we're often asked is, when do I need to make a will? So the answer is really if you have assets and if you have responsibilities. So if you have children, you will need to select a guardian, and if you have assets, you need to set out who you want to receive those assets. And then the other question we're often asked is, how often do I need to review it? So if you have particular tax planning needs, you need to review it annually. You need to discuss it with your tax advisor, because there can be changes in every Finance Act. If you don't have particular tax planning needs, what we just say as a general rule is have a look at it every 5 years, and certainly have a look at it if your circumstances change. One of the things that's often overlooked is that marriage revokes a will. So if you marry, you need to put a new will in place. Next slide then, Hubie. What do we need to cover in my will? So I've set out in this slide the bones of a will. Appointment of executors, guardians, trustees. They can be the same persons, but it's often a good idea to separate those roles. So in terms of executors, we can have up to 3. Trustees, if the trust holds property, you need to have a minimum of 2 trustees. You can have more than that. If you have 3 trustees, it's a good idea to think about whether you want to put in a clause that allows trustees to act by majority, or whether a unanimous decision is needed. You can often put in a professional person as well to act as executor and trustee. We'd really only see that if a person has a high value estate, or if perhaps the estate involves a business and they need some expertise. Other than that, it's not necessary. Sometimes we'll have older clients come in who might not have somebody else who they can select, and they would put in a solicitor or an accountant then as executor or trustee. Funeral and burial wishes only if desired. Sorry, Hubie, have you a question?
Yeah, just a question that came in there, Ruth. Do you have to specify everything in a will, or can you just say your estate is left equally?
So I love dealing with things in terms of percentages, because your estate can go up and down in value and percentages won't change. We have seen cases where people leave high value bequests and the money just isn't there to pay them, and they haven't subsequently reviewed their will. But no, you don't need to name everything. You can do an entire estate to be divided up after particular bequests if you want. There's no need to go through every single asset.
I suppose the one thing is that whoever is left behind knows where all those assets are, is a crucial thing.
So you can leave your list with your accountant. It's a really good idea to have your copy of your will at home with your box of papers, and it's usually that box of papers that's delivered into the solicitor on death. We tend not to store details of people's assets. We don't have the storage capacity, and also people's assets change constantly, so we'd have people constantly coming in with new details if we were to do that. But your accountant will often have that information. So okay. Funeral and burial wishes, we tend to see this less frequently now, because often somebody is buried before we even see the will. So the undertakers are taking a lot of that detail and keeping it on file, but generally just communicate it to your family. Bequest is to dispose of an estate. So this is just if you want to leave a legacy, or you want to leave a specific item to somebody. And then you'll provide what's called the residue clause. So who receives all after you provide for those bequests. Substitutionary clauses, that is, and it's an important thing to think about, the gift over clause. If your beneficiary predeceases you, who would you like to receive their benefit? Okay, move on to the next slide then. will probate be needed on my death? So people actually tend to get quite angry when they find out that they have to take out probate. They think that I've made a will, why does it need to go through the probate process? But the probate process really involves all estates. So if you die leaving a will, it is a grant of probate. If you die intestate, it is a different type of grant. The grant of probate is an easier grant to obtain. It also obviously, it depends on what's in the estate. So if you hold property in your sole name, you will absolutely need probate. If your assets are above a certain value, you will need probate, and that really depends on the financial institution that you're dealing with. As a general rule, we'd say about €25,000 if your estate is below that, you won't need to go through the probate process. Over and above that, you will. The probate process is actually very quick at the moment. From lodging the papers, it's taking about 3 weeks, so they've been absolutely brilliant during the pandemic.
Question here, Ruth, on probates. So it looks like somebody doesn't want the value of the estate published. So
yeah, so that you can send in a letter. What happens is the papers go in and they ask for the top 10 estates of the week, and it's published. Now, I have often put in the letters where, you know, you just for various reasons, you don't want it published. You are in the probate office's hands on it. And sorry, actually you're in the newspaper's hands on it, whether they will publish it or not. So it's worthwhile putting in the bequest, but there's nothing to stop them from doing it. It's a matter of public record.
Okay, and if somebody hasn't gone through the probate, the next question, or the second carry-on question from the client would be, can they transfer any of the assets directly to shall we say, it goes from a husband to a wife and then from a wife to the actual children?
So the husband has died, and
yes.
Husband has died, assets pass to the wife, and the wife does a lifetime transfer.
Well, I think the question is basically there's an ARF there that she doesn't want kind of the value to be published on it, so therefore is it best to transfer? No, it might be something we can come back to.
If probate has to come out in the husband's estate, then you can put in the letter requesting that it doesn't be, but again, you're in their hands.
Okay. We might go back to that one directly to the client itself. All right, thanks.
Joint tenancy, so most couples will hold assets as joint tenants, which means that you don't need probate on the death of the first spouse. It automatically passes on to the surviving spouse. Okay. Move on to the next one then. We tend to see a lot of estates now holding foreign property. And it actually does create difficulties in terms of administration of estates. So we had this new EU succession regulation, which came in, which allows a person to apply, depending on their nationality, allows them to choose which rule of law they want to apply to their estate. So if you are a French national, you can choose to have French law apply to your estate. Ireland opted out of the regulation, so it doesn't apply to us. The UK and Denmark opted out as well. However, it can sometimes be helpful in that if you have assets in an estate which has what's called forced heirship rules, where a specified persons have an automatic right to property, you can say, well, I don't want that to apply to my estate, and I'm making a French will, and I'm saying I'm an Irish national and I want Irish law to apply. And the French authorities will accept that, and forced heirship rules wouldn't apply there. It's not helpful, the regulation, in that it doesn't regularise the tax treatment, so it's still each member state's tax treatment that applies, and also you still need separate grants. So when it comes to trying to put an Irish will through, for example, French probate process, it's more difficult than putting a French will through there. So what we advise generally is wherever you hold assets, make a separate will in each country, making sure that that will doesn't revoke the will in the other country, and that it's just that will is just dealing with the property in that country. It makes the administration a whole lot easier. Unless you have any questions on that, we'll move on to the next slide. So capital acquisitions tax, we just have on this slide a lot of the general information, which I think there'll be good knowledge about. CAT obviously applies to gifts and inheritances. To calculate your CAT, you need to know which threshold you fall into. So we have 3 thresholds: Group A, Group B, Group C. Group A is children, Group B is other relatives, Group C is strangers in blood, really. And then if you have previous gifts within those threshold, it reduces your available threshold, and the excess is taxed at the current rate, the rate currently is 33%. It is whatever the rate is applicable at your date of death in terms of an inheritance. Last year, the yield to the exchequer on CAT was 533 million. In terms of the groups, Group B, in terms of inheritance tax, 230 million was paid. And on the gift tax front, Group A was 37 million. And just, it's an interesting breakdown.
Yeah, but I suppose that's the one thing that people, you know, they've worked hard all their lives, they've built up assets. They want to make sure that as much of the maximum amount can be passed on to the next generation.
Yeah, and sometimes that just involves very simple tax planning.
Yeah, yeah. I suppose that's a good thing to kind of, we're going to hear how you're going to do that for us, Ruth.
Yeah, we will. So I'm just going to look at 4 reliefs today. There are other reliefs. Small gift exemption. So if we just go on to the small gift exemption, we're going to look at dwelling house exemption, business relief, and life assurance relief. And the next slide is dealing with small gift exemption. So this exemption, you can receive up to the value of 3,000 from any person by way of gift, not an inheritance, in any year. And you don't pay CAT on this, and it doesn't reduce your tax threshold for the future. So whichever Group A, Group B, Group C it falls into, it doesn't reduce that. So these are 2 frequent examples that we see. And that is, for example, a parent gifting to a child or a grandparent gifting to a grandchild. So if we, in the case of 2 grandparents, they could each gift 3,000 per annum to their grandchild. Over a 10-year period in this example, that would amount to €60,000, and that wouldn't impact the grandchild's Group B threshold in the future. So they could, over a period of 10 years, pass on 60,000 to the grandchild. And again, in their will, they could also leave the Group B threshold, which is 32,500, to that grandchild. So they've effectively handed over 90,000 tax-free to the grandchild. Often you'll see the grandparents or parents, they don't actually want to physically hand over this money and set up an account in the grandchild's name for obvious reasons. So what they do is they can actually set it up an account in their name, and they'll get the solicitor to draft. It's a 1 to 2 page document called a Declaration of Bare Trust. And this is a document to say that although they are holding this is money that they have handed over to the beneficiary, and they hold it on bare trust to them. So when the grandchild reaches 18, the grandchild is entitled to call for these monies to be pointed out to them. And this is a declaration that Revenue might just look for to make sure that this gift has actually passed.
Just a very, very quick question on that, Ruth. Grandparents can do 3,000 each. Could the parents do 3,000 each, so the child could get a total there of
so you
whatever,
can get it
4,
from any disponer.
6?
Yeah.
So you can get 3,000 from anybody.
So you're not restricted in receiving 3,000 to yourself. You can receive it from multiple disponers. Yeah.
Okay. Perfect. Lovely.
So the second example there, and this is another frequent example where we see where a parent wants to help child out with purchasing property. If they were to gift the amount of money to the child, it's going to either, CAT is either going to arise or it's going to eat into their Group A threshold, which they may need in the future. So what the parent does is they lend the child an amount of money to assist them with the purchase. And it has to be formally written up in a loan agreement, because Revenue could call for that in the future. And then they write down that loan annually using the small gift exemption. So in this example, I just said that over a period of 16 years, parents could lend to a child 100,000 that would be written off under the small gift exemption, again, without using up the Group A threshold. If they were to include a spouse in that, and sometimes it's not always a good idea, but if they're to lend the amount of money to the spouse, to the child plus their spouse for assisting with purchase of the property, would take 8 years to write that off.
Okay.
Happy to move on then. The next relief is dwelling house exemption. This relief was really popular until 2016, and it was used a lot for gifts where a parent would buy a high value property for a child, or any value. The child would move into it for 3 years, and then they would transfer the property to the child completely free of capital acquisitions tax. So Revenue unfortunately did away with that relief in relation to gifts. It's still there for dependent relatives. For inheritances, it's there for the disponers. Take the example of the parent for their main residence. So now the disponer, the parent, has to be not just a parent, but the disponer has to be living in the property for 3 years prior to their death, as well as the beneficiary. In addition, the beneficiary cannot be entitled to any other property. So that we don't see that relief as frequently now, because often parents don't want to be living with children, and vice versa. So we can do planning around that, and we're going to deal with that at a later stage. One thing though is we do need to exercise caution. So if you have a child who is living with you and you're targeting this relief in your will, you need to ensure that you're not leaving that child an interest or even part of an interest in any other property. Because if you do, they won't be able to avail of dwelling house exemption.
Okay.
Moving on then to the third relief that we'll look at is business relief. Business relief reduces, as we say in the slide, the taxable value of business property by 90%. So Irish tax policy is really supportive of businesses transferring between family members. And the purpose of this relief is really to prevent the sale of the family business in order to meet the capital acquisitions tax bill. The conditions on the relief is the business must have been owned for 5 years in the case of a gift, 2 years in the case of an inheritance. The beneficiary must retain ownership for a period of 6 years, and the business must qualify as relevant business property, which we're going to look at on the next slide. Next slide there, Hubie.
Yeah.
Sorry, yeah. So it's essentially a trading business, a business or an interest in a business carried on by a sole trader or a partnership, or unquoted shares if the relevant conditions which I've set out in that slide are met. In addition to the business, you can transfer land, buildings, plant and machinery owned by the disponer and used in the business if they're taken with the shares or interest in the business. So if you're passing on the business premises along with the business, that would also qualify for business relief. And then the fourth relief is CAT, is the Section 72 and Section 73 policies. So the Section 72 policy, don't see this too frequently, but if you have a high value estate, it really can be of assistance if you can afford the policy. So basically is a policy which it covers the inheritance tax bill of the beneficiary. It allows the beneficiary to inherit the asset without having to find the money to meet the tax bill. It's essential that the proceeds of the policy are used to pay the tax bill only. So the computations around tax have to be dealt with the financial advisor who's putting the policy in place to make sure you get it as accurate as possible, because any proceeds of the policy not used to pay the liability are going to be subject to CAT. And we also as solicitors have to make provision for that policy in the will. Sometimes on the policy there's also a period where I think sometimes it can be 1 year where the tax has to arise. So you need to be, again, for the solicitor, when you're drafting the will, you need to ensure that the benefit can be paid to the beneficiary within 1 year. So sometimes in trusts, if you're using a trust, that might not be possible. So again, it's just something to work on, your solicitor, you and your financial advisor in unison to make sure you get it right. The other type of policy, and again, this isn't really too frequently used, a Section 73 savings plan. It's used to fund CAT on gifts, but because of the minimum funding period of 8 years, I don't see it too often. Now, Hubie, you'll probably be very familiar with Section 72 policies.
Yeah, exactly. But I mean, they're very much on an individual basis, and they are something that people do look at. So it can come in. The earlier you look at doing Section 72 or Section 73, the better it is for you and for your estate. Yeah. Listen, any queries on that, very happy to answer them later.
Okay, if we move on then. So trusts and I suppose the use of trust, it's a really important element of estate planning. Sometimes people hear the word trust and think it's more complicated than it is, but really we have three uses for them. So to protect vulnerable beneficiaries, and this is one of the most frequent reasons that I create trust and wills. We'd have a lot of clients with just a person with special needs in their family that needs to be protected through a trust. We're going to look at that. If you're leaving a life interest to somebody, in fact, a life interest creates a trust because the trustees manage the life tenant's asset during the trust period. And the other reason for use of a trust is for tax planning reasons. So we're just going to look at on the next slide a really simple example of a trust. This trust is what's called a bare trust. It means that the beneficiaries are entitled to call immediately for the asset to be appointed to them. And it's trust that is used a lot. So if you have an estate where you know that you're certain that you are going to be able to provide for the bequests that you want to leave in your will, you simply go ahead and you leave whatever amounts you want to whoever. But if you're not sure whether you'll have enough money in your estate to pay bequests to grandchildren, what you can do is you can divide up your estate between your children. And this just gives an example of 2 children. So you're leaving the residue or the entirety of the estate, whatever you prefer, to your trustee to divide in 2 equal parts between your 2 children. So your first child takes up to their tax threshold, 335,000. But it is whatever the rate is, threshold is at your date of death. Only if that half of your estate goes above that figure will your will then provide that your grandchildren will also receive up to their tax threshold, which is the Group B threshold, which is 32,500. And if there's an excess on that in your half, it simply goes back to the child and they pay the tax on it. Now you can include spouses there as well. People tend not to, just don't know how marriages are going to work out, and people tend to keep matters, keep the estate in the bloodline. But obviously you can do it. It only represents a very small saving adding in spouses. So that's just really simple tax planning, and we do that frequently in wills. Moving on to the next slide then. So a will trust for vulnerable beneficiaries. So in terms of a child, if you have a grandchild in a will, there's no need really to set up a trust if the amount is below €20,000. What you can do there is simply, obviously a minor cannot give a receipt to an executor. So what you do is you just put in a straightforward receipt clause that their parent or guardian can sign a receipt and the money's handed over to them and they manage it or hold it until the grandchild's 18, and then it's appointed to them. And the executor has no other involvement once it's handed over. When it's above that amount, you're going to need a trust. And a common will that we do, and most solicitors do, is that if you have a couple coming in with children under the age of 21, they make mirror wills, leaving all to each other, appointing each other as executor. And in the second part of their will, they'll pick who they want as their executors, trustees, guardians, and then they will leave their estate into what's called a discretionary trust. And that trust will last until their youngest child is 21. It has to be appointed out just before their 21st birthday for tax reasons. That's actually a really good will. It allows for tax planning to happen during that period. And it's a bog standard will, but it serves all purposes. And what we would say to people, look, that's the will to put in place if you're in that scenario, and then review it when your youngest child is around 19 years of age. Come back into your solicitor then and revisit it.
Okay. Good advice.
The other reason is discretionary trust. So this is vital for a person with special needs or improvident beneficiaries. So an improvident beneficiary, just to make you aware, is that a person in Revenue's eyes is somebody who might have an addiction or might have a compulsion to spending to excess. And we can set up a discretionary trust for them, and we can do it without paying discretionary trust tax, which we're going to look at in a minute. So a discretionary trust on the next slide is basically a trust where a beneficiary doesn't have an absolute entitlement to to the asset. And that's important because once you have an absolute entitlement, you are liable to capital acquisitions tax if you exceed your threshold. But with a trust, you cannot say the person has an absolute interest until the asset moves out of the trust and put into their hands. So ideally, we would all have a discretionary trust in our will, and we would hold the asset in trust until we actually want it and just pay the tax then. But obviously, for that reason, revenue have to tax those trusts because otherwise we'd all avail of them. And the trust tax charge is, there is an initial charge of 6% of the value of everything in the trust. If the trust is appointed out within 5 years, you get a refund of 3%. There's also an annual charge of 1%. But we do get discretionary trust tax exemptions, which we'll look at on the next slide in certain cases. And those,
sorry, Ruth, quick question in there. The initial charge is 6% and the annual charge, does the actual trust itself pay that, or who has to?
The trustees would pay it. The trustees would register the trust with revenue, and they're responsible for making sure that there's an annual return to be filed every year. They're responsible. So that
comes from the trust funds as such? Yeah,
absolutely, yeah.
Thank you.
So then the tax planning uses, so the exemptions, there are exemptions available, and those exemptions are, if you have a vulnerable beneficiary, person with special needs, or an improvident beneficiary, usually a letter from the doctor will suffice. You submit that to revenue and you'll get the exemption from discretionary trust tax. Those trusts are really important for those persons, because otherwise it might, if the asset wasn't in the trust, they would, depending on the value of the property, they could lose any means tested entitlements. It also means that you are covering in your discretionary trust after the person's time how you want the trust funds to pass. And it also just makes sure that somebody is there, trustees are there to manage their funds, because they may not be able to, obviously they are unlikely to be able to manage that asset themselves.
Okay.
One other, now we didn't look at agricultural relief on these slides, but discretionary trusts can be of assistance there. So recently we've had clients where the trust might have a lot of cash in it, and the beneficiary the trust could purchase the likes of agricultural property, and the trust would be able to appoint the agricultural property to the beneficiary, who would claim a relief called agricultural relief, which basically reduces the value of the asset by 90%. So it's kind of similar to business relief, and so discretionary trust in terms of tax planning can be really useful depending on the reliefs that are being targeted.
Okay.
And we're going to look at discretionary trusts and dwelling house exemption. So we discussed the exemption on an earlier slide, and I mentioned that we might have a situation where the parent doesn't want to live with the child, or vice versa, for the 3-year period prior to death. So what we could do in that scenario is we could put the property in discretionary trust in the will. So if the parent in this example on the slide had a property worth, say, 700,000, and they wanted to leave it to their child, then after allowing for the CAT Group A threshold, there'd be a tax bill of 120,000. But if the parent put the property into a discretionary trust under the terms of their will, and if the beneficiary moved into the property for a 3-year period after the parent's death, the trustees could then appoint the property out of the trust to the child, and the child would claim dwelling house exemption. So that would mean, obviously, they're not living together in the 3-year period prior to death. Obviously, the child has to be interested in doing that. You wouldn't put it into the will if there wasn't a general intention that would be done. And so there would be a discretionary trust tax charge to that. The property would be in the trust for a 3-year period, so there'd be you wouldn't be paying the 6% charge, you'd get the refund of 3%, and there would probably be a 1-year annual charge. So you'd be paying in the region of 4%, which, looking at that example, it's a whole lot less than the CAT liability that would otherwise. But the other thing it does is it actually preserves the CAT threshold, because you may have other assets that you want to leave to the child in addition to the property, and it saves that. So you just, in calculating whether this should be done, it just depends on the value of the property and what's in the estate, but it's often really good and simple planning again to put into a will. Sometimes you can even, rather than enforcing the planning and enforcing the trust, you can actually just leave the property to the child, absolutely, and give them the option to disclaim it into a discretionary trust in the will, and they can then decide at the time of death, in conjunction with their tax advisor, will I avail of this option or not? Okay, we'll just move on to the next slide then. Nursing home support scheme. So this is, it's one of the big influencers for clients now making lifetime transfers. The caveat on it is that assets transferred in the 5-year period before you go in and avail of the fair deal are basically brought back into the pot. So it's too late really if you're trying to do it just before entering into a nursing home. Essentially the scheme looks at 80% of assessable income, pensions, etc., and 7.5% of your assets, with an asset disregard of 36,000. Your family home is disregarded after a 3-year period. So you won't see, you tend to find that after 3 years, the state pays more and you pay less. And I'm going to look at the nursing home support scheme on the next slide. So lifetime transfers, we have downsides to doing a lifetime transfer, and they are stamp duty and capital gains tax. But there's various reliefs that can be availed of for CGT. Principal private residence relief if you're dealing with your family home, and there's also capital gains tax against CAT offset for the beneficiary, which I'm not really going to go into today. The lifetime transfer, so setting up, we've discussed discretionary trusts that are set up in a will. You can also set up a discretionary trust during your lifetime, where you are the setter, you put the asset into the trust, you're also the beneficiary of the trust, and you can include your children, grandchildren if you want as beneficiaries of the trust as well. What you can't do is also be the trustee of that trust. So if you do that, really Revenue are going to say this is a sham, it's not a true trust, you're in control of it, it's not a discretionary trust. You could be one of the trustees, but you would need to be probably the minority of the trustees. So if you wanted, you could have your accountant in there, your children. Now, obviously, there are dangers with that as well, but if it's something that you think could work, there can be benefits. So where I see the lifetime or inter vivos discretionary trust work the easiest with is with cash amounts. And I just take one example of if you had, say, a cash sum of 500,000, and just looking at if that 500,000 was held by you when you were applying for the likes of nursing home care, then allowing for the different 7.5% and allowing for, say, a period of where you were in a nursing home for 5 years, of your 500,000, you are going to pay 174,000 of that towards your nursing home costs. If you had instead put that into a discretionary trust prior to the 5 years before entering into a nursing home, then on your death, the discretionary trust tax would be payable. And if it was appointed out within the 5-year period, that discretionary trust tax bill would be at 4% and it would be €20,000. So a big saving between that and the nursing home contribution of €174,000. The downside is you've moved this asset out of your name, you're not in control of it anymore. Okay, it's in the control of the trustees. Other lifetime planning that's done is a deed of family partnership. And where I see that most often in our office is where parents might contribute money on behalf of themselves and their children towards buying a property. And basically it just allows, the gift happens when the monies are advanced, and the parents are make all the decisions under the deeds of partnership, and it allows the asset to grow in value without the child paying CAT at the other end when the property is handed over to them or sold. They receive it at the initial stages when the property is being purchased. You can do deed of family partnership with a minor child, and if you do that, you just need to set up a bare trust for them as well. Moving on to the next slide then, lifetime transfer of a business. So there, in terms of capital gains tax, there is retirement relief available. So if the individual is if you're disposing to a child, full relief is available if you're between the age of 55 and 65. And if you're 66 and older, the relief is restricted to 3 million. If you're making a disposal outside of your family, relief is 750,000 if aged over 66, and 500,000 if under 66, 500,000 if over. The other relief is entrepreneur relief, and the CGT rate is 10% on gains from disposal of qualifying business assets. And sometimes you satisfy the conditions of both reliefs, and it's necessary just to do a calculation to work out which is more tax efficient to use. So both reliefs really are for trading businesses. Moving on then to the next slide. Other key documents for business owners. So if you're a shareholder, shareholders agreement is just absolutely vital. Every issue should be considered when drafting the agreement, and the agreement, when it comes to estate planning and what we're dealing with, it usually contains buyout options which provide for what happens on the death of the shareholder. And normally you'd also have, along with that, a shareholder protection policy, which is a life assurance policy. And it just means that there will be funds available to buy out that shareholder. And it's really important, if there isn't going to be cash reserves in the company, for that to be in place. Then we have key man policy, and that's really just a policy to protect the business and the survival of the business on the death of a key person, a key employee. So
yeah, no, I think kind of Ruth, just on that, actually, kind of something that came up recently with ourselves in Bluechip was the company lost one of the partners, and unfortunately didn't have the funds to buy out the estate or the wife of the other partner. So I think, something like the insurance that you have here and business protection, it's very, very valuable. Look, that's been a great, lot of stuff we actually touched on. A lot of good topics. There's a few questions I want to get to as well too, Ruth. Okay. So, but before we get to there, just kind of hopefully get the right poll this time. Yeah, there we go. Kind of second one in. So I'm going to relaunch this, and what we really kind of would like to hear is what topic really kind of is something you want to hear most about, and that would be great to kind of give that information so we can get back to you. As I say, there's a lot of information in that. The slides are available. Just contact us. We'll be able to pass them on. There's a recording there as well too. And do appreciate your time, Ruth, in particular. Thank you very much. That was very, very informative. It's been good. I'm going to leave that poll kind of bubble away in the background. But just actually, there was quite a few questions in relation to the gift of 3,000/6,000 to anybody.
Yeah.
From a tax revenue point of view, do you have to actually declare that? And obviously, kind of, no, it's tax-free. So you don't declare it, and it's tax-free. No,
it's tax-free. But you definitely need the documentation there if they look for it in the future.
Okay. Yeah. So the documentation, it's important to document it, but not actually have to pay anything on it. Yeah.
If you are holding the investment on the person's behalf in a bank account, you need the declaration of trust. Other than that, where we see people use it is they go into the post office every year and they put 3,000 in and they just top that investment up every year. Credit union is often used, bank accounts, but you don't need to document that because the transaction is there to document it.
Okay, good. Another question that we got as well too in relation to discretionary trusts, and say for example, could the discretionary trust be used to avoid problems with means tested benefits? And I suppose that's back to the nursing home.
Yeah, but it comes at a cost. So if you don't qualify for an exemption, that also comes at a cost. So as I said, with the nursing home support scheme, the cost works out very well there. It's €20,000. Whereas you're looking at 170,000, I think it was, in nursing home costs. Now, look, all of this is subject to review. So I often wonder why, they haven't looked at under the Fair Deal scheme at this a bit more, and that's not to say they won't in the future. But for now, there are savings to be made by dealing with your assets before you require nursing home care.
Okay, good. I'm just going to share those results actually that we came up with. So it's quite interesting. The lifetime transfers and the wills and incorporating of trust seems to be the two popular one, over 50%. So, you know, it's great. It's great to have that. Thank you very much. So I suppose really the key thing is if we haven't answered your questions, please send them in.
Yeah, no, feel free to send on any.
Absolutely, yeah. And look, the other thing I would say to you as well too is that if something crops up in the next day or two that you might have actually should have asked that question, by all means send it in to ourselves. Like it's becoming more and more topical. I think as people are actually beginning to focus in on their wealth and their estate, they begin to realize that a bit of planning makes a huge difference for those left behind.
Yeah.
So listen, Ruth, thanks very much indeed. You've been very good.
And thanks to everybody for taking the time.
Exactly. Yes, thank you all for joining us, and we appreciate your time. Again, we'd be very happy to hear your feedback on what you felt worked for this, and if you would like anything similar along the lines, please let us know as well too. All right. Thanks very much indeed, everybody.
Bye-bye.